Well, the economy is basically recovering from two powerful blows in the last 2-3 years. The pandemic, the Russian invasion of Ukraine that has disrupted energy markets and has raised prices of food and energy around the world. And so we're on a mending path. We are still convalescing, if you want. So growth is expected to be somewhat low. We still have an inflation problem. So inflation is still high and it requires monetary policy to tighten, and central banks have been doing that. And so that's why we have this sort of broad trajectory. But around that, we also have the financial instability that we've seen the last month. We've seen a little bit of it in the last year as well, in the second half of the year. And that is creating some downside risks for our global trajectory.
Let's start with inflation. The report is saying that inflation is proving to be stickier than what people had anticipated. How problematic is that going to be for the central banking community? And do you see a risk of a wage spiral?
Well, so first, yes, inflation has been stickier, especially when we look at core measures of inflation. It excludes the very volatile component, energy and food prices. In many countries, it's still going up. It has not started coming down. Headline inflation has come down, but it's mostly energy prices have been falling, food prices have been going back down. And so that's the concern, because that underlying inflation is what central banks are looking at, because it's a more stable measure. And the fact that it's still high, in some cases even increasing, means that central banks need to still work on trying to cool off the economy. And so going forward, this is what they're doing, and we can anticipate that they're going to keep doing that. Now, in terms of the wage price spiral, to be honest, this is not something we're overly worried about. What we've seen in the last year is prices rising very rapidly, but wages have not increased nearly as much. And that's why we have a cost of living crisis. People find that their income in real terms has been going down. So we should expect wages to catch up eventually, and people's real income to recover. That means at some point wages will have to go up, and that's perfectly normal. The question is whether this would trigger a second round. Right now we don't see much signs of this. And why? Well, because in part the corporate sector has been sitting on pretty comfortable margins. When prices rise faster than wages, then your revenues rise faster than your costs. And as a result, in the corporate sector, the margins have been quite healthy in the last year. So they have room to absorb rising labor costs. Exactly.
About 6 months ago, when central banks really started aggressively tightening monetary policy, a lot of the discussion we had was about the trade-off between growth on one side and containing inflation on the other. And you fast forward to today, and what I thought was really interesting about your report is you don't see a recession in the US for the calendar year in 2023. If anything, you see a mild recession in Germany of minus 0.1% and a milder one, also mild one in the UK of minus 0.3 percentage points. Does that go to say that there isn't actually as big a trade-off between growth and inflation as we thought there was going to be?
Well, there's still a trade-off. And even if you look at the US, we expect a slowdown in terms of output growth in the US this year and even next year. We expect unemployment to be increasing. Under our baseline, unemployment could be increasing in the 4%, high 4% by the end of next year. So there is a slowdown, and the path to avoid a recession in the US is narrow, but we cannot guarantee that one will be avoided. The discussion has shifted, as you point out. It's less about growth versus inflation. Now it's more about financial stability versus inflation. Can central banks keep tightening policy rates if that's going to create financial instability? And here our assessment at this point is central banks and financial authorities have the tools to address pockets of instability that might pop up. Things like Silicon Valley Bank in the US, or things like the LDIs, the liquidity-driven investment in the UK back in the fall. And if they address these pockets of instability, then monetary policy should stay focused on bringing inflation down. And so that's our recommendation at this point.
How would these financial instability risks manifest themselves in terms of lower growth expectations?
So we are concerned about what we have seen in the banking sector, in particular in the US, but also maybe in other countries, might do to growth in 2023. What is going on? Well, we've had, as a result of the increase in interest rates by central banks, the funding cost of banks has gone up. They have to pay more to their depositors to keep them. We've seen depositors leaving banks because they are not getting compensation that is high enough. And they've also booked some losses on the asset side. They've realized losses on their holdings of long-term bonds. And so banks are in a more precarious situation. They have healthy cushions, but it's certainly going to lead them to be a little bit more prudent and maybe cut down lending some. And when we run our models and we look at what might happen if they start tightening lending beyond what is already there, we find that it would have an effect on global growth. It would bring it down from 2.8% in 23 to 2.5%. Now that's a scenario where financial instability is still contained. It's just the banks deciding to be a little bit more prudent and cutting down lending. There is also a more adverse scenario. That one would be associated with much more financial instability that would not be contained, and that would lead to massive capital flows from the rest of the world trying to go back to safety, going to US treasuries, dollar appreciation, increase in risk premia, loss of confidence. You put all of this together, the impact on global growth would be much more severe, would be growing at about 1%. But of course, the probability that this would happen is comparatively low. We find that it's maybe around 15%.